Hello and welcome. It's April, which means it's tax time, and it also happens to be Financial Literacy Month. Here to help us think about those topics and look at how we might best plan not only for taxes, but also for our own financial well-being and charitable giving over the course of our lifetimes are two individuals from the Evanston Community Foundation. Sarah Shostak is the president and CEO of the Evanston Community Foundation. She's been with them since 2001. And Julie Captain is a board member, and she sits on their development committee. She's also in charge of planned giving at the Evanston Community Foundation. She also works as the regional development director at Conservation International. Thank you so much for taking the time to do this.
It's great to be with you.
So, Financial Literacy Month, in addition to tax time, we're looking at everyone's individual tax concerns. We're looking at what things we can do to save money on that bill on April 15th or whenever the day falls. But we're also thinking about how this would affect an organization, for example, such as the Community Foundation, where you're a very active grant maker. You take a lot of charitable donations, but you put them right back into the community to the tune of almost $6 million, as I recall. So what would we like to say to the Evanston community at large when we're thinking about these issues? What's our central message?
Our central message is that almost everybody can be a philanthropist in some way, to some extent or another. We can make gifts of small sizes or larger sizes. They're always appreciated. And we at the Community Foundation are especially interested in supporting organizations who really support the growth of financial literacy within our community. There are dollars that can be brought back to Evanston through things like the Earned Income Tax Credit. There are many women in the community and others who have not had the opportunity to really learn how to manage money. And because money management and being able to take care of one's finances is really part of getting the next step up and raising your family and working in the community, we really like to support organizations that do that kind of work in Evanston.
Okay, let's start with the first question that most people think about when it comes to tax time. To itemize or not to itemize? What do you think?
Well, if you can itemize, if it's worth it to you, it's amazing what you can do. You have the opportunity with a publicly supported charity like ours to give as much as 50% of your adjusted gross income if it's cash, and up to 30% of your income if you're giving appreciated securities. Now that's the upper limit. There's a lot more that you can do below the upper limit, but there are a lot of benefits for charitable contributions like these, and I think the main benefit that people think about in April at tax time is that they are getting to make decisions about where those dollars go, rather than letting Uncle Sam make all the decisions.
Indeed. But who's going to be able to give away up to 50% of their income?
Not most people.
Certainly not I.
But sometimes you are in a situation where maybe you've sold a privately held business, or maybe you're getting a special bonus in a given year, or maybe you're starting to draw that required distribution from your retirement plan. You might find yourself in some special circumstances that you should give that a look.
Absolutely. And there are certain times in one's life where, for example, Sarah mentioned when you're required to take income from your employee-sponsored retirement assets. So that could be an IRA, 401k, 403b. And for anyone who's getting ready to turn 70 and a half, you should really be conscious of what is your total adjusted gross income today, but then looking to see how that income will affect your taxes next year. Because if you're right on the brink of being at the upper limits of your current tax bracket, receiving income could put you in that next tax bracket. And so not only are you going to have to pay more tax, but the rate at which you pay tax is actually going to be higher.
Right.
So that's something to kind of plan ahead for if you're 69, 70 and approaching that age. And I think the other important thing to remember that Sarah mentioned is that, you know, most people aren't going to deduct 50% of their adjusted gross income, but, you know, sometimes people towards the end stage of life, after they've accumulated their assets, they've put their kids through college, they've reduced their annual discretionary spending, and they really want to make a special gift to a church, university, the community foundation, someplace that's been special to them for many years. They will make kind of a once-in-a-lifetime special gift. And that might be the year where it does approach 30% of their adjusted gross income if they're giving from their assets, not just their discretionary income. And so the thing to keep in mind is if you should find yourself even in a year where you're crossing that threshold, let's say you give a lot of stock that you've had for years and years and years, that's just not paying you any dividend, then if that happens to be 40% of your income, again, if maybe you're retired and your income is lower than it was when you were working, you can actually even carry that forward for up to 5 years after that first year of the gift. So it's a good limitation, and it's one to know that you can extend it if you should surpass it. But it's also important to remember that a lot of people like you and me, we give a lot of money in a lot of little ways over the course of the year. And sometimes people don't recognize how that accumulates. And in the aggregate, supporting your church every week, supporting your friends' charity events, supporting universities, supporting your kids' fundraisers, that can all add up. And that might just be 3% of your adjusted gross income. But it really then goes back to our first question of maybe there is a year when you have a lot of those little things, and it is better to itemize because all of those add up to more than your standard deduction.
So I think the key lesson here is really to be aware of what your income is going to be for any given year, not to wait till the end of the year to figure it out, but to really look ahead and see what you're going to be taking in and where your tax brackets are going to lie and where your priorities then will lie.
I would even say that's especially important now, because the federal government, the tax rates have been in flux for the last 10 years. Our previous president had tax brackets set in stone, and that was supposed to change once President Obama came into office. And so those tax brackets are in flux every single year. So it really is important for people to know that you might be in a 25% tax bracket this year, but that's not a guarantee you're going to be in that same bracket next year, the following year, even if your income stays the same. So again, I really echo your comment. It's important to kind of plan ahead. When you're doing your taxes this year, think about next year and keep your eye out in the news for any announcements about how the tax law has been going to change.
Okay. Tell us more about stocks, ladies. How do you make a gift using stocks? How does this work?
Well, first of all, you have to find an organization that can receive that has the capacity to do that. But then you look at your portfolio, and the general thing that we look for is highly appreciated stock that we've had maybe for a really long time. Maybe there's an old blue chip stock that you've had for 40, 50 years. It's appreciated a lot in those years. And if you were to try to sell that stock, maybe to get more income as you go on in life, you would really take a bath with capital gains on that. And so that's a really good stock to give away, because if you were to sell it, you would end up paying more tax on that. But if you give that to an organization, a church or a university or a community organization such as ours, you can actually give the full value of that stock as it's been building up over the years.
And supposing you give a stock that you've had for many, many years that has appreciated X-fold, if that stock has reached a point where its value in total at the time of donation is greater than your income for that year, can you continue to use that as a deduction in succeeding years against your taxes?
Yes. So again, the limit for giving highly appreciated stock is 30%. So again, if you've crossed that threshold, you can deduct that 30% in year one, but you have 5 more years to continue to deduct that balance until you've either fulfilled the balance or you run out of 5 years.
And that's called the carry forward. If your accountant talks
Carry
about
forward, exactly.
carry forward, that's what he or she's talking about.
So giving an exceptionally highly valued stock like that is a gift that keeps on giving, both to the organization you donate to as well as to yourself.
That's right. That's
Excellent.
right.
does sound a little bit too good to be true. How is it that the government has allowed this?
Well, it's an interesting question, isn't it? But our tax policies tend to mirror our social policies. And so the government is allowing people to make their decisions about some of the funds that they can give to organizations, which means that the government is not having to make decisions about some of those programs. So it's allowing some liberty to everyone to make some of those decisions themselves. And that is something that we enjoy right now. We can't really take it for granted. There have been some conversations in Washington in the Senate Finance Committee about changing the rules, because this is now also, you can say that it's money that's not going to Uncle Sam, and if there are deficits, and we're trying to pay for tax reductions for some parts of the population, this is money that some folks would like to see coming to Washington in greater measure.
Now, where does the Evanston Community Foundation fit into the picture of all of this giving?
Well, that's a really great question. Just as an individual might have an investment portfolio, a set of mutual fund shares, you invest in diversified stocks to supplement the kinds of income and growth that you can see over your lifetime. The Community Foundation does the same thing. We're unusual in community organizations in that we're really based on building endowments for the future. And so for us, helping people think about gifts that are made with some of these appreciated assets is part of the service that we provide to community members.
And when someone donates to the Evanston Community Foundation, where does that donation goes into your endowment, of course, but where does that endowment then go?
Where do the investments go?
Exactly.
Well, the investments go into a portfolio of mutual fund shares that are purchased by the foundation. They're held over the long term with guidance from an investment committee of professionals in this area who volunteer their time and their services to the Evanston Community Foundation. And they make decisions based on the policy that's been set by the board about how those funds should be invested. Again, we're trying to generate funds today in the grants that we were talking about before and growth for tomorrow so that we'll be able to do more in the future, and so that the gifts that people make today for things that they hold very dear, like perhaps a fund for the arts or one for women and girls, for example, you want to know that we're going to protect the purchasing power over the long haul so that your gift will be worth more 50 years from now and will keep up with the cost of life at that point.
So, Julie, for those of us who don't understand how an endowment works, what does this mean to give this kind of a gift to an endowment?
So, in its most basic terms, an endowment is kind of the savings account, the long-term savings account of a charity. So what is given into that endowment is protected and cannot be spent. And the charity only spends a small percentage of what that endowment earns every single year. So that core is protected and is the seed for the future. Now, in the terms of Evanston Community Foundation, we're really proud of our endowment's past performance and what it's been able to provide since the beginning of our history and what it will continue to provide in the future. In fact, if a donor would have made a gift of $100,000, or I should even say if the community's gift of $100,000 back in 1988, shortly after we were first founded, that $100,000 would have grown so much that it would have both paid out to the community over $216,000, and as well, that $100,000 initial fund is now $261,000, which will continue to generate more and more income as it grows and as our investment performance continues. So it's incredibly powerful to know that this gift has grown, or this amount of money has grown 2.5 times its original size in just under 25 years.
And still giving out over twice its initial size in that time to the
Right.
community.
So that just goes to show the incredible power of money over time. And if that $100,000 had been spent in 1988, it would be gone. But today, it's still worth over $260,000 in the foundation and has also paid out more than twice the value of that original fund into the community. So there's a trade-off. Obviously, if you use all the funds today, you can make a very powerful immediate gift. But if you use some of your funds to contribute to endowment, you're really ensuring the future in a way that's pretty dramatic.
And so these investments then allow the foundation to continue giving grants and providing financial support to a variety of charitable and worthy causes throughout Evanston.
Right, that's right. And we're trying always to have that be more money. And we've all seen in the past few years, particularly since 2008, that there have been reductions in budgets of governmental units. And there have been private foundations, for example, with fixed level of assets that lost a lot of their portfolio's value. They had to tell grantees, sorry, we can't increase you, sorry, we have to cut you off after this year. So we are trying to constantly build what's available for Evanston's future, so that as these things change over time, there's something steady that organizations in Evanston can count on.
And how did the foundation weather the financial crisis of 2008-2009?
We weathered it well. We had a decline in the asset value of just under 20%, and that was an excellent return in very, very troubled times.
Yeah.
And we actually had some very substantial gifts in 2008. So as Julie knows, at the end of the year, we actually had more in our endowment than we'd had at the beginning of the year, and probably not too many organizations had that outcome.
No, I don't think so.
Agree. I mean, already Evanston Community Foundation's endowment is able to distribute hundreds of thousands of dollars a year. In fact, this last year we granted over $261,000 to organizations of all shapes and sizes around this community. So everything from arts to human needs to programs for seniors, early childhood education. And so as Sarah says, what's important about this endowment is that, through the good times and bad, having just come out of a bad one, we can see how when other organizations are suffering because their sources of funding have been restricted or permanently or temporarily halted, this endowment that's here for the community can continue to be that safety net for Evanston. And if anything, even help them grow and be more vibrant for the future.
And we actually, our story is even a little bit better than that, because if you add together the different grant programs that we give grants through, we were over $650,000 last year altogether. We have partners who support us with gifts that take the place of endowments. So if we have a $100,000 grant program, that's making up for $2 million in endowment that we might not have earned yet. So there are a lot of ways that we can support donors in doing things to help the Evanston community.
So we've talked to this point about gifts that we make from our checkbooks or with appreciated stocks. Are there other ways to give? Other ways to donate? Other ways to reduce your tax burden?
Absolutely. People think of giving as, what can I afford to give this year? And that's your discretionary income. And so one of the really rewarding things that the Evanston Community Foundation can help people do is help people know of the different ways they can give. And one of the simplest ways to do that is to think about your long-term assets and your long-term estate plans. And so what many donors think about doing is, if they support an organization like ECF every single year, year in, year out, they want to know, how can I continue to do that even beyond my death? And how can I, or maybe I would like to make a substantial gift to the endowment, but I can't write a check for that much money, as much as I'd like to give. Well, we can work with donors to help them make an addition to their estate plan. So that could be if they have a will or a trust. They can, if the time is right for them to kind of do a more comprehensive look at their will, we can help them add in a clause so that after someone has provided for their heirs, their spouses, they can think about the community and what they would like to do for the community for the long term. And then there are also very simple ways to do that. Many people don't realize that retirement assets that we've mentioned before, your IRAs, your 401ks, even life insurance, including term insurance that you might have through your employer if you still work, you can simply name a charity as a beneficiary in addition to maybe a spouse or children. And that way those assets, when they come due either at the time that the insurance kicks into place or even if you pass away before all your retirement assets have been used by you, they will go directly to that charity. And what's really important to remember is that many retirement assets haven't been taxed yet. So if you leave your retirement asset to your spouse even or your children,
they pay tax.
They have to pay income tax on that. So if you are charitably inclined and know that you want to be supportive of an organization that's important to you, if you're looking at everything being equal, if you have cash and if you have retirement assets, it's really wise to leave those retirement assets to the charity and your other assets to your heirs or to other individuals.
And sometimes the way people think about this is if they make an annual gift, let's say of $1,000 a year, what would it take to endow that gift so that the organization would always receive that $1,000? So if you think back to the way that most endowments work with spending somewhere around 5%, if you were to make a gift of $25,000 through your estate plan, that's going to take care of that annual gift right away, and that gift will grow over time as the endowment grows along with it. So there are ways of sort of plotting out what is it that I would like to do, at what level would I like to do it. And it's amazing how looking at small percentages, you don't have to even name specific amounts, but you could think, well, I'd like to use maybe 5% of my estate for supporting the things that I really cared about. I know I'm taking care of my family, and now I'd like to do some things that reflect who I am in the world and all the things that I really valued about this community where I've lived my life and raised my family. It's a wonderful thing to be able to think about, and people sometimes feel a little calmer knowing that they've made some of these plans that reflect what they hope to do.
I think one of the special things about giving to an endowment at Evanston Community Foundation is if you have that passion of the arts or supporting early childhood education programs or helping underprivileged youth, we don't know 20 years from now, 40 years from now, what organizations will be the vibrant ones who can really provide those services to the community. And by setting up a fund at Evanston Community Foundation, you can rest assured knowing that if that's your specific interest, that Evanston Community Foundation and their staff will do the due diligence 5 years from now or 10, 20, 40 in the future to invest and give your money to the organizations that are fulfilling that need in the future.
Yeah, I do know from planning my own estate that when I planned out my charitable contributions, I provided my attorney with a list of charities. They then affirmed the existence of those charities and that they were qualified to accept donations. But at every turn, there was a statement in my will, if this charity is no longer in existence or no longer capable at the time of my passing, I direct this to a similar charity. But that leaves it to my executor to figure out who that similar or like-minded charity would be at that point in time when they're also dealing with the nightmare of my estate. No matter how neatly you plan, no matter how detailed it is, you will still be dead. The mess will still be there, and your executor will still have to deal with it.
Yeah, I think you raised some good points there. But hats off to you for having the plan. That is an element of planning. It's odd to me to realize this, but whereas maybe 65 or 70% of Americans give charitable contributions every year, the percentage of people who do what you've done, Janie, and make that kind of plan is only about 5%.
I know.
So that is that you've done something very significant. And the Community Foundation can really be a good friend to people like you. We don't ever ask that you tell us how much you want to leave, or even if you're just making a general kind of gift, you don't have to go into any of the details. But if you've got a complex plan, as you do, where you've got specific organizations and causes, we are happy to sit down with people and say, okay, what is it that you're really trying to get at here? What's behind those choices? And if those things were no longer in existence, or those problems weren't there anymore, what else would you like to do? I think anyone in our field knows about those odd gifts that a university gets a gift to support its Norwegian language study. Well, they phased out Norwegian 25 years ago, then what? And it can be a challenge for the organization to sort through all of those things, but the Community Foundation, in its charter with the state, has been granted the right to make those kinds of decisions, to modify restrictions as they need to be if the original purpose can no longer be carried out, or if it isn't practical to carry it out.
So for someone who has a great love of their community, this really, the foundation provides a way for simplifying what is really an awfully complicated process.
Yes, and actually what makes it even better is that the endowments that we hold aren't necessarily all ones where we make the spending decisions on behalf of the donor or on behalf of the community. So you could come to the Community Foundation and say, you know, I would really like to give some funds to organization X. I've been supporting them for a long time and I really believe in them, but I've been on their board and I know that investing money is not exactly where their passion is or their expertise. So rather than give them a problem, how about if I give you the endowment and you give them the distributions from that fund every year, so you're able to accomplish your purposes of supporting an organization in a way that's not going to present them with the headache.
So you're almost like an executor-in-law in that you can manage for someone their funds to carry out their wishes in local charitable giving after they're gone, is what I'm hearing.
We don't give legal or financial advice. That's not our area of expertise. But if you come to us and say, you know, I'm planning to do something like this, can we talk about exactly what my vision is? We can make some suggestions along those lines that would help you do what you want to do.
Okay. So if somebody really wants to do this, where do they go? How do they start?
Well, many people work with lawyers or accountants or an investment advisor, someone that they trust a great deal, that they're accustomed to making decisions with. And it's good to go to your advisor and say, I kind of have this in mind. Some of them are really very aware of all of these vehicles, but not all of them. And so, you know, you need to find the person who shares your interests and values. You can do a lot of reading on your own. You can talk with the Community Foundation, get in touch with us. We can't give you advice about your particular circumstances. You need to talk with an accountant. You know, does this make sense for me, or how might I do this? Sometimes there are cases, I bet you've dealt with some of these, where people actually come out better by making these gifts than if they hadn't.
Absolutely. Oftentimes it's a win-win. It's a win for the donor and their family as well as the charity. And so it is important just to start that conversation and to really think of this as a team process. So you, the donor, your trusted advisor, whether it's an attorney, your banker, your accountant, someone who knows your entire financial story, and then if there's a particular charity you're working with, look to see, do they have expertise in-house? And then the Evanston Community Foundation, especially if if you have a number of different charities you want to support especially, I would suggest the Community Foundation, because that might be one good, like you said, source where they can then steward that gift in perpetuity.
Okay. Summing up then, number one, be aware of not just what you make this year, but how much you're going to have in income next year. Plan this year for next year's taxes. Number two, think about how something that might cost you money in taxes could actually save you money in taxes by donating, and that donation could continue on over years in the carry forward. Number three, talk to a trusted advisor who knows your financial picture, and if your giving is related to the community, if you really want to look at gifts close to home here, things that matter to you in Evanston, the Evanston Community Foundation can help look at stewarding that gift.
I think those are all very good tips. You've summarized that really well. Every year we make grants to maybe 40 or so different organizations. So we know a lot about what's going on in Evanston. And if you decide to make a gift to the Community Foundation, you can be confident that every year it's going to be, the benefits are going to pass to a very wide part of the community, and that sometimes is good to know. I'd also add one other thing, that if you have a really big plan, a sort of Daniel Burnham make no small plans approach to all of this, it might be a good idea to tell your children what you have in mind. Try to enlist their support. Maybe they would have ideas about this too, and having a family conversation around this can be a very important part of planning, so that this is going to be a happy event for everybody.
As happy as it can be.
As happy as it can be. Yes, I should have said that.
Well, and on that positive note, we'll wish you the best for this April. Happy tax season and happy Financial Literacy Month. This has been Sarah Shostak and Julie Captain of the Evanston Community Foundation. We hope we've helped you with some of your financial literacy. Best of luck.